You are listening to Keystone's Stock Talk Show, episode 230.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a busy show for you planned this week as we prepare to launch our fall 2023 DIY stock investment webinars. Tickets will go on sale at the end of the week, so get them fast. Aaron will talk about, to launch the show, his upcoming appearance on Money Talks with Michael Campbell, where he recommends 3 unique stocks. I will hit the mailbag this week and answer a question on Spin Master Corporation, symbol TOY or TOY on the TSX, a children's entertainment company that creates, designs, and manufactures via outsourcing and markets a diversified portfolio of innovative toys, games, products, and entertainment properties, including well-known names such as Paw Patrol, Bakugan, Kinetic Sand, Air Hogs, Hatchimals, Rubik's Cube, and Gund. The company announced a significant acquisition this past week, and a viewer wanted to know if this is a new buying opportunity. Next, in our Your Stock Our Take segment, Brennan answers a question from a viewer on Jamieson Wellness Inc., symbol JWEL on the TSX, which develops, manufactures, and distributes, as well as markets and sells natural health products, including vitamins, herbal, and mineral nutritional supplements for humans in Canada and the United States of America, as well as internationally. The business, which is posting strong revenue growth and pays a 3% dividend, sells a product designed to help improve your health. But can the stock improve your portfolio? Brennan will let you know. Last and not least, Brett, one of the guys, who knows really, let's be honest. Brett answers a viewer question on Hive, digital technologies, symbol HIVE or Hive on the TSX, a growth-oriented technology stock in the emergent blockchain industry. With a bit, no pun intended, of a resurgence in Bitcoin and blockchain-related businesses, Brett lets viewers know if Hive is a good option to participate in Bitcoin and or blockchain's future. Okay, let's get to the show. Welcome, my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Brennan and Breton.
I don't even know their names. The Bretton Woods, Brennan.
Yeah, it sounds like Brett's sending me his slides here, and I'm gonna do Hive.
Good idea. We'll flip.
Sure, let's do it.
Yeah,
let's see. You guys just flip out those and see how you make out with that.
Yeah, be rough.
So, Aaron, you just prior to this recording, you recorded an interview with Michael Campbell to air this weekend, I believe, on Money Talks. Correct? How'd that go?
Yeah, it was good. It was good. Always a fun time. And obviously there's a lot to discuss, a lot happening in the markets right now. So people will be able to see that segment on the Money Talks podcast on Saturday. But
it drops then. Other than the 3 stocks, what did you talk about?
So we talked, really obviously about the current market environment, which is typically how we would start the show. But then just also a little bit about our webinars upcoming, and then just about some of the themes that would be, or things that we'll be talking about within the webinars. But just on the specifics, rising interest rates, how that impacts investing strategy. We talked about one of the interesting things about the market right now is that it gives the appearance, if you look at the headline numbers, that the U.S. market has really recovered from last year. With the NASDAQ up about 29-30% right now. But if you dig into the numbers, you actually find that it's more of a tale of 2 markets. So the top 7 companies in the NASDAQ, the mega cap 7, so this is going to be Microsoft, Alphabet, Amazon, Apple, Meta, NVIDIA, and Tesla. If you just take those top 7 companies, they account together for 11 trillion in market cap. That's half of the NASDAQ. So there's 2,500 companies on the NASDAQ. The top 7 companies account right now for about half of the market value. Well, those 7 companies are up on average from the start of the year 97% compared to 30% for the whole index. So that means if you take those 7 out, the rest of the other companies, almost 2,500 companies on average, have lost money this year. So you really, when you look at the market return, it's you're really looking at the return of the 7 top companies. Now, obviously, some companies within that other group, that the smaller group, the other 2,493 companies, some of them have performed well, others not, but on average, they're down in the double digits this year. Canada, the TSX about flat. So we talked a little bit about that, some like what that means to investors in terms of, you have these 7 companies, one way or another, you really should have some exposure to them. So we talked about one of our recommendations in that group, a little bit about how it's critical for Canadians to have some exposure to US stocks. We talked to a lot of Canadians that are just invested 100% up here in Canada. And the biggest reason that they give is, well, I don't want the currency risk, right? But we've showed in the past that the currency risk, avoiding currency risk, is not worth the lack of, like, the opportunities that you miss out on by investing in the US, right? We're so focused up here in Canada on resources and the big 6 banks, resources and financials being 60% of our market, technology being almost an insignificant part of our stock market. Whereas in the US, you just have much better diversification, breadth of opportunities, and certainly so much more in the technology space. So we talked a little bit about that. We talked about valuations for small caps, large caps comparatively, how that has changed just recently this year, how small caps are now actually trading at a sizable discount to large caps for really, the first time in almost 20 years. For almost all of the last 20 years, it's been the opposite. So again, what does that mean for investors? But then, obviously we were talking about the webinars. We have our webinars upcoming. We have our DIY webinar, which is really, we're providing education. We're also providing individual stock picks. Last year at the webinar, we recommended Hammond Power. That is up 250%. And, Hammond was just a boring manufacturing company that manufactures transformers. I mean, nobody really cared about it when we picked up coverage. But, it's all about the profile of the stock. And what we were looking at was a profitable, growing business with a growing backlog, solid balance sheet, and a great valuation. And, that's why we recommend it. It's been one of the top performers out there. Again, we can never recommend. We're going to be coming out with more recommendations at our upcoming DIYs for a starter portfolio. We can never guarantee that any of these companies are going to produce 250% return over the next year. But what we do say is that the more you invest in that profile of company, that profitable, growing, well-capitalized business with a clear and achievable growth plan, the better positioned you are to generate those types of returns in the future, either this year or next. So it was a good show. Everybody should tune in on Saturday. And of course, the DIY events coming up as well. Anybody who's interested.
Yeah, and we'll have information on those when we either next week or this week when we message out or send out this podcast as well, and we'll post them on the YouTube channel as well. Yep. All right, well, you want to move on to some of the viewer questions. I can get to the first one that was on Spin Master. I'll share my screen here. I've got a presentation on that. We'll see if it actually works. Probably not, but we will see if it does work. All right, here we go. Can you guys see that now?
You're good.
Yeah.
There we go.
Okay, good to hear. Okay, I'm going to look at Spin Master here. Symbol is toy, appropriately so, on the TSX. 36.65 is what it trades at. $3.8 billion market cap. They're a children's entertainment company. They create, design, and manufacture. Their manufacturing is all outsourced, and they market diversified portfolio of innovative toys, games, products, and entertainment properties. They are best known for some award-winning brands, including Paw Patrol, Bakugan, Kinetic Sand, Air Hogs, Hatchimals, Rubik's Cube, and Gund. many names that I recognize from that we've given presents to our kids in those areas. And some of the names like Rubik's Cube have been around for basically ever in the toy arena. So what brought us to the question today? Well, the company executed on an acquisition. On October 11th, Spin Master reported a sizable strategic acquisition. They acquired US-based Melissa and Doug, which are not just two people, it's a company. And they specialize in early childhood toys with high-quality offerings of open-ended creative and development wooden toys primarily, which will be complementary to Spin Master's existing portfolio. Let's look at that transaction. The price tag, the full purchase was about $1.1 billion, composed of $950 million. These are US dollars in upfront cash considerations and approximately $150 million in contingent consideration based on certain financial targets for the year 2024 fiscal and 2025 respectively. The $950 million upfront is to be funded through $450 million of cash from the balance sheet. Spin Master holds roughly Canadian $758 million in cash prior to the acquisition, with debt of just $66.9 million. And there's approximately $500 million of debt financing as well in this transaction. We do not know the acquisitions or Melissa and Doug's full debt position or balance sheet position, but Spin Master will be in a net debt position post-acquisition in all likelihood. It should not be an onerous one, given the strength of its capital structure and strong cash flow heading into the deal. Now, for the company's part, Melissa and Doug generated approximately $489 million of revenue US and approximately $90 million of EBITDA in 2022. This translates to a purchase price or EV to EBITDA multiple of 10.5, pre-cost synergies, which are about 25 to 30 million. If we assume a midpoint of those, the post-synergy EV to EBITDA multiple paid is estimated to be in the range of about 8.1 times their 2022 EBITDA. The transaction should close in the first quarter of the coming fiscal year, and the synergies should come through by the end of 2025, 2026, I believe. Let's look at the valuations here quickly. Following the announced transaction, based on the consensus forward EPS estimate in the range of $2.69, Spin Master trades with an EV/EBITDA multiple of 5.3 times and a PE of 13.59. Some comparables here. It's hard to have a direct comparison. Some larger companies like Mattel and Hasbro, they have, Mattel is about 17.5 PE, Hasbro is 14.7, but the sector generally trades at about 11.2 times multiple, whereas Spin Master is about 13.8 right now. So Spin Master is above the average. Track record of long-term growth is likely why you can see this, and some quality established brands, and they had that net cash balance sheet. Now, our take on it: Spin Master has a well-run business and has been a strong Canadian growth story. If we go back to 2015, the stock has more than doubled, or approximately doubled in value since that time. But over the past 5 years, the stock has been basically flat. This is likely due to the fact that normalized EPS over that period between now and 2017 is essentially been flat. The company had a spike in 2021 and in particular 2024 in terms of earnings, but the nature of its business is one of constant need for innovation. The goal to find the next great toy or toy line is always there. A hit can boost earnings significantly, a miss can hit earnings. Spin Master has shown a knack for hitting more than missing, and it's come along with great current and legacy cash producing brands that it's put under its umbrella, which is how it has survived and thrived, created a great cash rich balance sheet in a tough business. That helped fund the Melissa and Doug acquisition. It appears like a smart and kind of a less miss and more hit business in the long term. Or it's more of a hit. It's less of a hit and miss business is what I'm trying to say. But due to the fickle hit and miss nature of the toy industry overall and the lower recurring model of these businesses, the below average multiples in terms of this company and the sector relative to what the market trades at, they're likely here to stay. Uh, Spin Master offers reasonable value, but the earnings on a quarter to quarter and even year to year basis will likely always fluctuate. While we admire the way the business is run, it's just too difficult to forecast profitability with a high degree of certainty with a given year or even a 2 to 3 year period. We monitored it. Our kids love their toys, but we're not buying it at present, despite what look like reasonable valuations and what looks like a reasonable acquisition.
Right. The acquisition, I mean, it does look interesting. And this is what we talk about with having a net cash balance sheet, especially when you see market weakness, is it does provide companies with the opportunity to go in and purchase competitors and buy up market share that way. I will have to say, I do say $1.1 billion acquisition. That's a big deal relative to the size of Spin Master's market cap, which is about just under $4 billion. So, there's risk with that, right? When you're buying such a large entity, the seller always knows more about it than the buyer, and there's the risk of integration and financially the transaction not turning out the way it was initially expected. So that's something that investors would want to watch. But I agree with your analysis. It's an interesting company. The fundamentals overall look good, but it's just really hard to know what's going to happen financially with the company on a year-to-year basis, given how that industry operates.
Yeah, and I had a slide in there pulling up the 10-year revenue growth on the company in US dollars. If you look back to December 2023 or 2013, it had about 539 million in revenues. Today, trailing months is 2.36 billion. So great growth there. But halfway through that, about in December, as at the year end 2018, they had 2.2 billion, and it's really today, 5 years later, is just 2.3. So they've really kind of flattened out. They had a spike up in last year and the year before, but they've kind of flattened out. If you look at that 4 or 5 year period there between 2018 and today, and that's kind of on a gross profit basis, they're roughly flat, slightly above. So they've been able to generate strong cash flow, but to produce top line growth really hasn't been there. And they always have that. You have that hit and miss. And toys, kids are fickle. Like, they can love Paw Patrol can be the greatest thing, for example, in this 2 or 3 or 1 year given period, and then nobody could want anything to do with Paw Patrol, and it could be a toy that's completely off the shelves, or maybe it will be. There's some toys. I mean, it's hard to get a Barbie that lasts like 50. It's probably going to last 100 years, like an iconic brand like that. But I mean, they have a Rubik's Cube, which, there's probably not a ton of growth there, but they're probably going to milk some cash flows for that over a long-term period. This brand, Melissa and Doug, we have a number of their products in-house already. I mean, it's kind of puzzles and toys, maybe longer lasting. It's well thought of in the US Canadian parent community. So maybe that's a way of smoothing out and not having the hit and miss type fluctuation that you can see in earnings with a business like this. But I mean, it does look like a solid purchase. If they could get like a Mattel type valuation, then you could have earnings growth over the next 2 years, and you could have a valuation re-rating potentially to like the 17 times where Mattel is. But the sector overall actually trades below where Spin Master trades today, and likely because it's difficult to sustain. You don't have a recurring toy that just everybody buys every year. You have to love that toy. You have to continue to, it has to be in, right? Like, it has to be, it's like fashion in some degrees. I mean, toys, it can become a toy that, you don't want to have, for example, Paw Patrol anymore, right? Like, no kid wants that. And then suddenly, it may be a great toy, but it's not in. We're not buying it this year. So that is one thing that can happen to this business. And that's something that, for like, how do we factor that into a model or any type of future cash flow? It's just really difficult, other than to say we know that this will be a company with lumpy earnings. I got to say, they've done a great job with innovation, like with the Hatchimals and all that. Like, they come out with winners year after year after year. So, you're betting on management and the team there to continue to innovate. If they can, then it trades at reasonable valuations. It's just, it's very hard to predict that going forward, other than to say you're investing in this management team. They've done well in the past. I think they'll do well in the future. And I guess that's what you would go on in this business. And maybe that's less tangible than we typically like.
Yeah,
is what I'm
and
trying
like
to say.
things change, and like this is something that I realized not too long ago. Like I don't know how you guys ended up getting your teaching your kids how to ride a bike, but these new glider bikes, like training wheels, are kind of almost becoming a thing of the past. Where I use training wheels to learn how to ride my bike. Still, yeah, I've got training wheels on my bike. No, I do not. But seeing my sister's kid. She doesn't want anything to do with the training wheels. She's basically learning the balance with her glider bike. And, is she even going to go to training wheels? Will she kind of skip? Will she go right up to almost, a bike without training wheels? It's just, it's interesting to see how things change when, I was on training wheels till I was like 13 or 14 and just
28, 9.
No, but
yeah,
anyways,
no, it's true.
Things
do change, and they've found a way to innovate, and I think this is a good buy. Like I think that it's well thought of. I'm not sure the growth path. Maybe it continues to grow, but the one analysis that I saw on it was looking for 6 to 8% accretion to earnings. Well, they paid about 8 times EV to EBITDA, so they're paying a fair to, it's going to be a long payback period on this, it would likely seem, but if you've got a brand that, if Melissa and Doug 50 years from now continues to grow over that period, it can be a great purchase, obviously, right? So it does seem like a well thought of brand, and if they take it over and continue to grow it, it could be a good situation for them long term. All right, let's get to our next company. I think Brett was going to look at Hive Digital. It is Hive Digital now, isn't it?
Yeah, it is Hive Digital now.
Yeah.
Digital Technologies, I should specifically say.
Yes, Technologies. Yeah. All right, you take a look at them and we'll get into it.
All right. Hive Digital Technologies, symbol HIVE, or Hive on both the TSX Venture as well as the NASDAQ, is a growth-oriented technology stock in the emergent blockchain industry. The company's revenue is currently dominated by its Bitcoin mining activities, but it is also working in the high-performance compute, or HPC, space at this time. The stock is up 94% year-to-date, trading at 407 Canadian and $3 US at roughly 360 million Canadian market cap, or 260 million US, but it is highly volatile. So by the time this release, that is completely wrong. So why am I really covering this? Well, Bitcoin-related stocks have seen a bit of a pickup in attention recently, as the Grayscale Bitcoin Trust, symbol GPTC, on the OTC won its lawsuit to convert its fund into an ETF. And the appeal date has passed. For the SEC appeal date has passed last week. So effectively, this just sets the way for a spot Bitcoin ETF in the US, which opens up Bitcoin as an investment to more investors, as some are restricted to certain things. And it obviously is normally the institutional, they're restricted to exchange-traded funds, etc., instead of buying the actual underlying. So it's really a decent time to look at, is there value in the space? So I will be focused on the Bitcoin operations, that is just the lion's share of the company's revenues at this time. But they have been dipping their toes into HPC since the Ethereum mining is no longer an option for use of its GPUs, and they've been also buying more GPUs as of recently. The company is expanding these operations in light of the AI boom, which requires a large amount of compute, specifically AI GPUs. But they have not really made an impact on the financials at this time, and they just invested in some more recently, so you might start to see it by the end of this calendar year, but even then, I don't think it's going to be a significant portion. So a quick run through of the basic structure of Bitcoin mining, as it confuses many people, but it's in fact very simple in how it really works financially. We're not going to really worry too much about the technical aspects, just more the financial aspects. So Bitcoin mining is done on application-specific integrated circuits, commonly known as ASICs, which are really just computing hardware built to be optimized for a specific application or algorithm, which in this case is the SHA-256 algorithm for Bitcoin. It's a general encryption algorithm. It's used for other things, but the most notable application of it is Bitcoin. So I will note, just as a side note, you can actually run it on anything practically, not just ASICs. You can run, there's been people who mine Bitcoin on the original Game Boy that was released in the late 80s you can run it on a smart fridge, but obviously commercial and corporate entities are not doing it because it's not economical at all. So a quick look at a simplified structure for any corporate Bitcoin mining operation. There's really 3 requirements for mining: ASICs, which can be seen as a capital investment; electricity, which can be seen as an ongoing per unit increase; and then the building and location, which range from proper data centers to dedicated infrastructure to modified shipping containers, and it varies drastically on the organization. So marginal profit really is when Bitcoin received is valued at more than the electrical cost, and then overall profit is once the sum of the marginal profits cover the ASIC and the data center costs, and as well as any additional overhead, so your SG&A. For Bitcoin to actually, the Bitcoin that is actually received is really dependent on the percentage of hash rate or the calculation that the miner contributes to the total network, which is constantly going up over time. It is quite variable. I'll throw up a quick picture in post to show how variable it is day to day. The exact number of Bitcoins that they will receive as well isn't exact percentage because it's probabilistic, but the numbers we're dealing with are generally large enough to where the percentage of hash rate is close enough to the actual Bitcoin received. So each Bitcoin block is mined every 10 minutes, and it has a subsidy, so a fee which you will receive of 6.25 Bitcoin, as well as fees that are paid by the users for the transactions. And the subsidy, which that 6.25 Bitcoin is right now, it's cut in half every about 4 years. It becomes a bit shorter than that, but 4 years for all intents and purposes, with the next halving being due around April 2024, which effectively cuts revenue in half for every single miner across the board, across all the network. Because the fees that are paid by the transaction is normally at most it's a few percentage. This last summer you did see it go up to about 10 to 15%, but that was very short lived. But you saw that make headlines because it was a big deal. So really, why am I explaining this before even touching on the company? The reason is risks and what the company can actually control. They can't control the price of the ASICs as they roughly correlate with the price of Bitcoin at the time and how efficient they are. They can influence but not control the price of electricity by selecting the region, building certain infrastructure. They can, of course, control the type of infrastructure, which influences efficiency. And most importantly, they are at the whim of the price of Bitcoin, which is extremely volatile, as you can see from the chart above. That's a 5-year chart, and it's ranged from about 6K to upwards of 68K. And there's a high of last year, or late 2021, so about 2 years ago now, of 68,000 to about a low of 16,000 over the past couple of years. So it's very, very, very volatile, to say the very least. So moving on to the actual company. Per its last monthly update, which most public Bitcoin mining companies release, so you generally actually have a good idea of their financials before they release, at least on the revenue side. So for the September, the company produced 259 Bitcoin at an average of 3.69 exahash per second, if including its GPU operations, which mine other cryptocurrencies at this time, and they're looking to convert those into using for their HPC compute. They produced 269.5 Bitcoin for the month and 806.5 Bitcoin for what will be their fiscal Q2 2024, assuming that the audit doesn't change it or their end of quarter actually changes something, because you will see that. Normally it's not a big adjustment, but I've seen that many times for cryptocurrency miners where they do end up saying, oh, it overlapped a bit too much on this quarter for our calculations. It gets lowered by 10, it gets raised by 10. It's not uncommon to see. Unfortunately, unlike other miners, Hive doesn't release its costs in its monthly reports. Quite a few other ones do, which I always like to see, because then you get a more up-to-date financial as it's going. And it's obviously extremely volatile, so you want the most up-to-date information as possible. But assuming the costs are similar to the last quarter, it had 18.7 thousand costs per Bitcoin. So they are currently making profit on a per Bitcoin basis. But that's also an adjusted measure as well, which I will get into shortly. But assuming that they're in the same ballpark as this last quarter, it had an EBIT of 2.9 million and 5.3 million when adjusted. So they are making profit right now, at least on these bases. I will note as well, depreciation for Bitcoin miners is relatively meaningless, which is why you'll see a big depreciation adjustment out. As the ASICs valuation, which is where this depreciation value is coming from, is more, it should more be looked at as a fair value, as you can sell these used ASICs at nearly the same price as the new ASIC, assuming it's in working condition. You do have some that obviously will break down, but that's a relatively low amount. So GAAP earnings per share aren't really a good metric. It's similar in how REITs, you don't really want to look at GAAP, but you should still consider it, and why you are looking at these adjustments. You really need to go into the details. But even the adjusted EBITDA, very volatile. 5.3 million last quarter, negative 1.4 the prior, negative 1.9, positive 22.3, positive 11. There's just no consistency quarter over quarter. Even after adjusting, they're adjusting on a lot of stuff, and it is still very, very volatile. I want to make that extremely clear. So moving to the balance sheet, the company has a net debt and leases position of about 30 million and is holding about 59.5 million in digital currencies, almost entirely Bitcoin. They have small amounts in, I think it was Ethereum Classic, which they're currently mining on their GPUs, but nothing substantial. So if they were to liquidate these digital assets, the company would have about a net cash position of 29.6 million. Not saying they will, but many other companies have, and you'll see that quickly come to the cash. So it's not an entire useless metric looking at net cash plus digital currency, because it is a liquidative market. You could probably see it similar as a level 1 equity security that you'll see on a company's balance sheet, something like that, or a trading security, something in that manner. So moving on to valuation, which I specifically added a dozen asterisks to the adjusted EBITDA, EV EBITDA, as I'm specifically going to give them a generous adjustments to the generous, but to create a generous valuation to make a point. So first off, we use an adjusted enterprise value, which treats Bitcoin as cash, as I was saying before with net cash. It's not ridiculous, but it is abnormal, and it is extremely generous compared to a normal valuation. But looking at adjusted EBITDA is the problem. As I mentioned before, ASICs generally trade on their fair value, so depreciation doesn't mean much because the actual value doesn't follow the depreciation, and that's generally an issue with computers because they depreciate quite quick. So you have a very front-loaded depreciation expense, which doesn't match. So if you're buying a ton of compute or any data centers up, anything like that, it is depreciated quite quick, but that might not match the fair value. And that's a general issue with accounting, but it's specifically notable here. But the issue is their adjustment also removed the effects of impairment, which is meant to bring it to a closer to the fair value price. So they effectively removed the fair value consequences as well as the accounting consequences of a major cost. So it significantly inflates their adjusted EBITDA. And still, at that, the company is still trading at 9.4 times adjusted EBITDA of their adjusted enterprise value. Extremely generous, and that is still expensive. So if we were to compare it to trailing free cash flow, it's roughly 90 times. It has its own quirk to the metrics, but even then you can probably have a better idea that the company is extremely expensive at this time. So our take, to summarize the Bitcoin mining industry as a whole, is just you're really purchasing operationally leveraged Bitcoin, which results in higher equity volatility, but potentially higher returns than Bitcoin itself, which obviously traders love. But as a long-term investor, the risks are just astronomical. Hive is an extremely volatile in price and fundamentals, as they are industry price takers, and even under a generous valuation metric, the company is still expensive. So I'll open up to you guys if you guys have any comments at this time.
Yeah, I mean, it's interesting when you look at how the crypto mining or Bitcoin mining space works. Obviously, it's not just Bitcoin. There are other cryptos as well, like Ethereum, and each one works a little bit differently. But is it 21 million coins is actually Bitcoin is set up so that once it hits 21 million, there's not going to be any more coins. So nobody's going to be able to mine anything after that.
No,
right?
you can mine it. So they'd receive those fees, but they would, that's when the subsidy runs out. So the subsidies, effectively, you can see it as like a monetary policy with a set limit. So right now, I'll quickly bring it up. So right now there is, where are we? There is 19.5 million Bitcoin outstanding, and it goes to about, to hit that 100% supply, you're going out to February 8th, 2140.
Right.
But to get 95% supply, we're only in 2026. It significantly slows down because the subsidy is halved in every
less,
fourth
yeah,
year.
as you said,
Yeah.
every 4 years it halves. So even though we've got, 17 years before you can't mine Bitcoin anymore, as
No,
we get closer.
117
100.
years.
Oh, so 117.
Yeah.
Sorry.
Yeah.
Until
Okay.
you no longer receive the subsidy.
Oh, so it's 2140.
Yes, 2140.
Oh,
That's how much the
2140. I thought it
exponential.
was
Yeah.
2040.
Here, I'll
Okay.
quickly. This is
It's
actually
halving next
140
in
years.
April, right? It
Mhm.
halves
Yes.
next in April.
Roughly.
of
It's an
2024?
estimate always
Yeah,
whenever you
okay.
see those dates. I don't know if you guys can see it here. I'll put it up more visible on the podcast, but you can see down here. This is just a dashboard for Bitcoin. Down here under future Bitcoin supply, where did it moved it? So you'll see 95% by March 18th, 2026, 99 by 2035. But we're already at 93% total supply. Does really, if you think about the stock, does 7% dilution really change much of the valuation? No, it really doesn't. It might a bit, but it won't matter much. So like dilution for Bitcoin is more or less done. And the miners will still exist because they will still get their fees, which we can see somewhere up here. Right now, we're looking at a 2% fee to the total reward that they get, which includes the subsidy. So right now, fees, which they get from transactions, is only 2%. So if they were to receive the same amount of dollar value as they were now, when the subsidy removes, you would at least need a 50 times increase in value in Bitcoin. To give an idea.
50 times
increase. Yes, 50 times. So you'd be
Mhm.
looking at a bit over $1 million a coin.
Bit over $1 million a coin. Interesting.
Kathy Woods would love that.
I'm sure she would. And then Ethereum, just to kind of touch on Ethereum, because that's the second biggest crypto coin, right?
Yeah.
Mined differently. Now, they were going to change, or they did change the way that crypto is mined. They already did. And I had heard that was basically completely changed the profitability, or what was in it for the miners. So is it still profitable then to mine?
No, you actually cannot mine what is known as Ethereum. So this happened last September. They switched to proof of stake, which is effectively how people can make money off of it now, is they give it out for lending. Kind of. That's very oversimplified, but that's how you can see it. And they get about 4% interest, I think, on their staking. Versus miners can no longer do
4% return on your assets. Is that?
Yeah, effectively that's what it is. Plus then the price change.
Okay. Yeah. So Ethereum as a mining currency now
is gone.
Not really.
It's
it's a financing currency, right? Yeah. And then I don't know. I do remember looking at a breakdown of all the top coins, and once you get past, the fifth biggest coin, their market shares are pretty much negligible, right?
Yeah. So you can look at, I don't have it up, I'll put it up, but there's some people that use Bitcoin dominance metrics, and it's about 50% of the entire cryptocurrency market. But then a big subset of that is also stable coins, which are really just deposited US currency for the most part. There's issues with them that I'm not going to go into right now.
Right.
That's
it's
also
a complicated
a big
space.
It is very
definitely
complicated.
A lot to know. Yeah. For sure.
You just really know Bitcoin's the majority of it at this time.
Yeah. I was actually just on YouTube last night and came across a Vice documentary about the OneCoin lady who's like supposedly coined herself as the crypto queen, where they ended up raising, I don't know.
I thought that was you, Brian.
Billions and billions. No. I wouldn't be on the podcast right now if that was me. But no, she ended up stealing billions and billions and then disappearing. Anyways, I saw the documentary, and it's just like, all I could think is these poor people who had no idea what they were investing in. Yeah, you got to feel bad for some people that are just trying to chase the hype, and that's how you're gonna end up.
Well, in one respect, yes, you have some empathy for people that get caught off guard, but on the other, I mean, if you're just gonna go
a fool and his money,
like how much do you if I put a mortgage on my house and then go to Vegas and throw it on the crap table and lose it. I mean, I wouldn't lose too much sleep for me, because that's just not a wise thing to do. Right. So,
Yeah, the fraud in the entire cryptocurrency space has a lot of aspects to it as well. I love personally diving into it.
Mm-hmm.
I know you guys watch.
Well, there's many examples that you can dive
Exactly.
into, right? So,
yeah.
Like I even just saw one the other day about Logan Paul, where basically they were going to talk about, or they talked about this cryptocurrency on their podcast. And one of the co-hosts on the podcast were like, it sounds like you guys colluded to talk about this on the podcast.
Someone's watching CoffeeZilla, which I will put in
I was
the
watching
description
CoffeeZilla.
as well.
And they're like, no, we didn't collude. There's literally a video afterwards that comes out of them colluding right before they go live. And making this podcast, basically saying we need to buy more of this coin. It's just, such a sleazy,
So they owned it ahead, and then
exactly.
they have millions of followers, and then people bought it and they dumped it,
and they dumped it. So it's like
it's probably illiquid, relatively speaking, too.
Exactly.
It's impressive.
Like
should they not be in jail?
Well, and this is what CoffeeZilla, who I was listening to, and Brett saw the same video, is saying, is like arguing, these guys
I don't even think it's an argument, to be honest. But
well, it isn't. But why aren't they in jail?
Yeah,
that's the thing.
It's true.
So
it's true.
Well,
regulation typically takes 10 years to catch up, at least. So maybe in 10 years somebody will prosecute them,
then
and they'll get a slap on the wrist.
Completely.
Right.
So
all right.
Okay.
Let's move on to this. This is an interesting company, Jamieson Wellness, JWEL. I think they had a bit of they pulled back on their earnings estimates and revenue estimates for the year, but there is still growth. They have interesting growth, I believe, in China and in the US that's come online. And, the multiples look interesting, but we tasked Brennan, the young Padawan, to take a look at the company, and he's going to go through it. And pays a 3% yield right now, too.
Yeah, exactly. So Jamieson Wellness Inc., JWEL on the TSX, currently trading at a price of around $25. I believe it's actually up a little bit today as we're recording this, with a $1.04 billion market cap and a forward dividend yield of about 3%. So they actually just recently increased that dividend slightly by a couple cents, their quarterly dividend, but I'll get into that. So Jamieson Wellness develops, manufactures, distributes, markets, and sells natural health products, including vitamins, herbal and mineral nutritional supplements for humans in Canada, the United States of America, and internationally. I have some of their vitamins in my own cupboard in my bathroom, of course. So moving on. Why are you laughing, Ryan?
I don't know, just the way you said it.
But yes, I am a consumer of their vitamins. So looking at a few of their Q2 highlights, this slide does come directly from the company's investor presentation. I'm just going to go over a few of the highlights here. So number 2, on July 19th of 2022, the company acquired a company called NutraWise Health and Beauty Corp, which sells supplements under the U Theory, the U Theory brand, for approximately 265 million Canadian. Now, the acquisition was made essentially to provide the company with an expansion plan into the U.S., and they noted in Q2 that new SKUs have began to ship. Now, as well, number 3, the company also recently acquired the assets of its own Chinese distributor for Canadian 226 million in May of 2023. So that's, they're looking for more growth in China there. And the last thing that I wanted to mention here was just the number 6 down at the bottom. The company recently increased their dividend from 17 cents per quarter to 19 cents per quarter, which is great. The company has been increasing it every single year since 2018. Now, looking at the actual financials here, the company's Q2 2023 results were strong, with revenue up 50% year over year to $167.8 million. Now, this was due to about 4% organic growth for the Jamieson brands, as well as its acquisition and the sale of U Theory products in the U.S. So that was, primarily what the growth was related to. Now, adjusted EBITDA was up 27% year over year to $31.1 million. And we saw basically a bit of a reduce in the EBITDA margin here due to lower gross profit margins, as well as the integration of U-Theory. And adjusted diluted EPS was flat year over year at 32 cents. The balance sheet does look healthy with net debt of about 253.7 million and a net debt to adjusted EBITDA multiple of about 1.9 times. So, as Ryan said, the company did recently just kind of bring down their guidance a little bit. So, looking forward, the company reduced the upper end of their guidance from revenue growth of 28% now down to about 26% at the high end, as well with adjusted EBITDA margins now between 13 to 16%, rather than the previous 13 to 18% that they were guiding towards. And management noted that the reason for the trimming of top end guidance is due to post-pandemic trends the company is seeing in Canada and internationally as certain retailers manage their inventory and international markets manage through the backlog of new product regulatory approvals. Looking at adjusted EPS here, this was also revised downward, and it wasn't just the upper end here. They moved it to a range of $1.56 to $1.63, which represents about flat to 5% growth. And previously, they were looking at about 5 to 11% growth. So this is a substantial, decline here, revision. And on a forward basis, utilizing their adjusted EPS guidance, the company trades at about 16 times forward adjusted diluted earnings. And based on its quarterly dividend of 19 cents per share, or about 76 cents per year, the company's forward payout ratio is expected to be about just under 50%. So to conclude here, I think that Jamieson is interesting. The company is guiding to grow revenue at a great double-digit pace this year, but reduce the upper end of its guidance and adjusted earnings profitability lower. Now, the balance sheet remains healthy. The company has increased the dividend every year since 2018, paying an attractive 3% forward yield right now with a healthy payout ratio. The company appears to trade at a reasonable multiple and has a runway of growth opportunities in both the US, China, and internationally. But essentially, I think that it's crucial here just to see and dig in a little bit further on the growth drivers for 2024 to see if, their end customers are, getting that inventory down and to see what kind of growth we will be looking at to see if that adjusted earnings multiple is justified or not. But yeah, I mean, they've been increasing that dividend, great dividend payer. Love to see that over the long term. Yeah, I'll open it up to you guys.
I guess in terms of EPS growth, it looks solid for like 2018. They had 60 cents, then 2019, 74 on a normalized basis, $1.02 in 2020, $1.16, 2021, 2022, $1.29. And now the trailing is $1.18. So it's the first time they've seen a step back in terms of per share earnings. I'd love to know their outlook. I guess they don't have a published outlook for 2024. It's just for this current year.
Correct.
If we saw they were looking for 15 to 20% revenue growth and, back to 15, 25 or something percent EPS growth, then, you could pay 15 times earnings for that. If, they're going to stay on this like 0 to 5% EPS growth rate, it's probably fairly valued, or you don't want to pay 15 times earnings for it or anything above that. So if they can get back to the growth rate they had for about a 4-year stretch there as a public entity, they'll look great. It could be a business to own. If not, it's not, essentially, is the way I'd sum it up.
Yeah.
Aaron,
I was going to just say too,
Brandon,
an interesting defensive company kind of, like there's a lot of uncertainty in the markets. I don't know if people are just going to stop eating vitamins. Or I don't think so.
Yeah, maybe not. But I mean, there is some discretionary in there too. Like some people, it's not like an iron supplement. I don't think that they're selling that you need because you have an iron deficiency. I think I want to have, better collagen. Or I think I want eyebrows to grow faster. So I'm going to
my hair.
take this.
I want vitamin D because my
or
hair
there's
is
a
falling
nail.
out.
Yeah. Somebody wants more calcium. But I mean, if a lot of these things, if you do eat a balanced diet, you can get them from, right? So, but like if they're doing that, maybe it is somewhat discretionary, but probably not as discretionary as some other items like a 15th pair of shoes or something like that.
Yeah.
Although, some people, those aren't so discretionary. Then Brennan's one of them.
Yep. Top of shoes.
No, I mean, I'll side with Ryan here. It's interesting. Fundamentals generally look pretty good. Historic growth is good, but now, we've seen a hiccup in the earnings growth. Let's just, see another quarter come out, get a revised update for the next year, and see if they get back on track with the bottom line.
Yeah, and if you had if you were trading 13, 15 times below market multiple, and we thought they could grow 15+% going forward, and the payout ratio is reasonable, and we think they can pay down that debt reasonably, then it is interesting. But this is a hiccup in terms of per share earnings for the growth rate this year. You're looking good revenue growth, largely by acquisition, but you got to be able to drive that to per share earnings too. And there is some margin compression here, and we'd have to watch that going forward to see if we can have better cash flow, better earnings on the business. And if they are, then it could become interesting for sure. Yep. Anybody got some final comments? Are we good?
I think we should be
good.
Watch Aaron this Saturday on Money Talks, or listen to it. Money Talks podcast or radio. I think they've gone back on a radio station even in somewhere. We'd have to look into that. Maybe we'll tweet it out or send it out in our email for the show. All right. As always, I'd like to thank everybody for listening. If you're viewing this right now on YouTube, smash the subscribe button. If you're listening to this on iTunes, rate and review us. Obviously, only positive reviews. Keep your questions coming into our Your Stock, Our Take, and we'll endeavor to answer your questions every week. And as always, I wish you profitable investing. Thank you.
Thank you, everyone.
Thank you.
Thank you.